So here we are. The market is kicking off 2026 at, well, at or very near all-time highs. And if you feel like you've heard that story before, you're definitely not wrong.
Yeah.
This whole multi-year rally has been, I think, one of the most doubted, most second-guessed market events in recent memory. The resilience has just been astonishing.
It really has. And it brings up the one essential question for every single investor right now. Is this strength, this remarkable run, finally running on fumes, or is it actually justified by what's happening in the economy?
That's our mission today. We are going to cut through all that noise and unpack the precise setup for 2026 for you. We're doing a deep dive into the surprisingly resilient U.S. economy, the Fed's path, and of course the big one, the towering AI bubble narrative.
And we've put together a really complex set of sources for this. We have a comprehensive bull versus bear outlook from a major financial firm, a really in-depth debate on AI valuations, and some key insights on portfolio management that, address some very common investor questions.
Okay, let's start there. Let's unpack that core economic tension first. The consensus view, it remains relatively sunny. GDP growth has been, frankly, one of the most amazing stories of the post-pandemic era. And the expectation is for, just a slight moderation.
Only a slight moderation, and mostly in the back half of 2026. And what's so interesting is how long we've all been waiting for that moderation to show up. It just creates this natural skepticism around any forecast for slowing growth. And then on the policy side, the market is fully expecting the Fed to deliver that first rate cut this week.
Right, with maybe 2 to 3 more penciled in for the rest of the year.
Exactly. 2 or 3 more through 2026.
And the reason for that, the reason for the easing, the bulls argue, is that the whole inflation debate is, it's pretty much settled. The Fed can now shift its focus. It can look at the labor market and just take out some, insurance against a future slowdown.
And that leads you right into the pillars of the bull case. Beyond just the rate cuts, the outlook for corporate earnings is very, very strong. We're seeing favorable revisions coming through in key sectors. It suggests management teams are actually pretty confident.
Which brings us to the final piece. Valuation. Yes, multiples are rich. No one's arguing stocks are cheap right now in an absolute sense.
Sure.
But the bulls contend, and I think this is critical, that you should never view multiples in a vacuum.
Never. They're always relative to interest rates.
Exactly. So when you combine rich multiples with an easing cycle from the Fed and positive earnings, that valuation context looks a whole lot less scary than the bears want you to believe.
And what's really fascinating here is how the bears look at the exact same set of facts and just connect the dots completely differently. They see all these risks, tariffs, the AI bubble bursting, consumers losing purchasing power, and they think it's all being mispriced by, they're calling it irrational exuberance.
And they just don't trust those headline GDP numbers. They're arguing that the economy is a lot shakier than it's being advertised, especially once you look beneath the surface.
Which leads them to their biggest fear.
Stagflation.
Stagflation. It's a critical distinction because it completely limits the Fed's ability to ease. If inflation pops back up or the economy slows while inflation stays sticky, the Fed is just trapped. And if that macro picture is as shaky as they think, then those really positive earnings estimates for 26 and 27, they just can't be supported.
Let's hold that thought on recession risk for just a second. Because if you look back over the last few years, the narrative predicting this imminent recession has just been consistently completely misplaced. The one where this has defined this whole period has been resilience.
It has. And that resilience is reflected in what corporations are doing. Management teams, by their very nature, they're incentivized to underpromise and overdeliver. If there was some huge systemic cliff right beneath the surface, a big drop in demand, they would be signaling that by now. The fact that the earnings outlook is actually improving is a very, very strong counter-argument to that whole bear case.
Okay, let's pivot a bit.
Yeah.
Let's go from the big macro debate and dive into market structure. Because the question you always hear at these high index levels is whether the strength is just a handful of huge stocks or if this rally is actually broad-based.
Right. And technical analysis confirms the bull trend is intact. But you really have to look under the hood. We have to check the market's breadth.
So how many stocks are actually participating in the rally?
Precisely. And if you look at the equal weight S&P 500, where every single stock has the same influence, that index is almost making new highs right alongside the normal S&P 500.
That is a direct challenge, then, to that narrative that it's only the Magnificent Seven driving the market. If it were only them, the equal weight index would be lagging way behind.
Way behind. And we can drill down even further. You look at mid caps, the MDY, and small caps, the IWM, they are both pushing toward new highs. When you see that kind of participation across large, mid, and small caps, that's a key sign. It tells you the bull market is robust and, well, pretty healthy.
All right, now for the main event. The central conflict that's fueling all of this anxiety. The AI bubble debate. Has the market just placed too big a bet on this?
Well, the thing is, it's academically impossible to know if you're in a bubble in real time. That call always comes after the fact. But what we can do is compare today's metrics for the Magnificent Seven or AI leaders against the big historical benchmark, the 2000 tech bubble.
And what does that comparison tell us?
It tells us that today's valuation is far more rational, as long as the growth comes through. The Mag 7 leaders today traded about 26.8 times their forward 24-month PE multiple. The valuation for the tech leaders back at the 2000 peak, it was 52 times.
Wow. So today's valuation is nearly half of what it was at that bubble peak.
Half. It's so easy to forget how insane those valuations got in 2000. So that really reframes the current anxiety.
But even if the absolute PE is lower, they're still trading at a premium to the rest of the market, right?
They are, but even that premium isn't excessive historically. Right now, it's a 35% premium to the S&P 500. That's actually below the 10-year median premium of 45%.
Okay, this is where the growth story really comes in to justify things. The PEG ratio. We hear this term all the time, but for listeners who are smart but maybe not finance pros, what is the PEG ratio and why does it matter so much right now?
It's a critical distinction. The PEG ratio is simply the price-to-earnings ratio divided by the expected earnings growth rate. It's the classic metric you use to check if that high growth you're seeing is justifying the valuation. A lower number is better. It means you're paying less for the growth.
And what does the PEG ratio tell us about the Mag 7?
It tells us that when you factor in that enormous expected growth, the valuation looks even more attractive. The Mag 7's collective PEG ratio is trading at 89% of the S&P 500's PEG. So mathematically, you are paying less for a unit of future growth in the Mag 7 than you are for an average stock in the index.
So if the conventional metrics don't really scream bubble, then the question becomes about the infrastructure spending. Can the ROI possibly justify this staggering, massive $3 trillion bet on AI?
That's where you have to look at the financial ecosystem. That $3 trillion investment, which is for 2025 through 2028, is about half funded by the Mag 7 themselves. And they have fortress balance sheets to do it.
And the other half?
The other half comes from non-banking institutions, venture capital, private equity funds. They are all betting heavily on this, and that's the real risk. If the rally stalls, it's these private creditors, the underbelly of the expansion. They'll be the biggest losers, not the big commercial banks.
Still, the cost is just staggering. I saw one CEO note that spending trillions on data centers just might not pay off. And JP Morgan calculated that $5 trillion in global spending by 2030 would need to generate $650 billion in additional yearly revenue just for a 10% return. That's a huge hurdle.
It is, but for the big foundational players, the decision is moving beyond a simple ROI, or return on investment. It's now about RIO.
RIO.
Relevance instead of obsolescence. In the next 5 years, they simply cannot afford to miss this shift, even if the payback is uncertain.
Well, the evidence of exponential progress just reinforces that urgency. This isn't linear. The cost of using AI models is falling off a cliff. More importantly, the length of tasks AI can do is apparently doubling every 7 months.
A staggering rate of improvement. And we're finally seeing hard data back it up. Recent studies show 74% of companies are reporting positive returns from Gen AI. That really pushes back on some of the earlier, more pessimistic data points.
And the potential market goes so far beyond just knowledge work. I mean, AI could automate half of U.S. work hours by 2030. That redesigns jobs worth $2.9 trillion a year. Plus, tech CapEx is now contributing about 3 times its historical average to U.S. GDP.
And you have 2 long-term demand boosters that are, I think, very hard for analysts to fully price in right now. First is the infrastructure for physical AI autonomous machines, self-driving cars, humanoid robots. That's a whole other level.
A turbo boost for science and engineering.
Exactly. And second, there's this huge guaranteed market for sovereign AI. Nation states wanting their own secure models to analyze their own data economy, resources, citizens. That's a layer of guaranteed demand that is not going away.
All right, let's transition from those huge debates to some specific insights that address common investor questions. First up, the long-standing worry about the yen carry trade unwind.
Right. For those who don't follow it closely, this involves borrowing yen at Japan's zero-ish interest rates and investing it in higher-yielding U.S. assets.
And the fear is that if U.S. rates fall and that spread narrows, traders will have to unwind, dump U.S. assets, and crash the market.
The good news is a massive sudden unwind is pretty unlikely. The spread is still profitable at around 2%. And more importantly, if you look at history, past crises like in 97 or '08 were not caused by the yen carry trade unwind. Sure, it made liquidity issues worse, but through it all, U.S. Treasuries and the dollar were the ultimate safe haven.
That's a critical point. So even if the trade shrinks, it probably hurts Japan's exports more than it destabilizes the U.S. market.
Absolutely.
All right, we'll finish up with two exciting stock picks that analysts see as well-positioned for 2026. First, a small-cap AI enabler, INOD.
This is a sub-$2 billion company that is tackling the single biggest headache in AI right now: data preparation. Businesses have to find, prep, and clean their messy internal data before an AI model can even touch it. IBM noted that while 81% of data officers are prioritizing AI, only 26% feel their data is even ready. InnoData solves that exact problem.
And they already have 5 of the Mag 7 as customers, which is a huge validation. Analysts see it as a minimum 30% compounder.
They do. And my top pick is a classic: Goldman Sachs. They are the undisputed leader in investment banking and trading, and they've smartly refocused on their core competencies. They shed their consumer bank division.
And why does getting rid of that consumer business make them stronger right now?
It reduces their regulatory capital risk and allows them to command a higher multiple, which is exactly what we're seeing. And the macro environment we talked about, an easing Fed, more risk appetite, is a perfect tailwind for their core M&A and IPO business.
The valuation isn't even stretched, despite a great run.
Not at all. It trades at a 66% multiple relative to the S&P 500. That's well below its 10-year high. And the earnings outlook for 26 and 27 is just steadily improving. It's a really compelling play.
So what does this all really mean for you as you navigate 2026? I mean, we've seen a clear split. The technicals and the macro resilience are strong, backed by good earnings and an easing Fed. The AI debate really boils down to whether these massive valuations are justified. And relative to history and growth, the data suggests the risk is worth taking.
The core strategy is, I think, quite simple. Stay invested. Build your positions if you're underweight, and just focus relentlessly on quality stocks. Positive, improving earnings outlooks, strong financials. And getting some exposure to that AI development cycle seems highly desirable.
And this all raises an important final question for you to think about. We've heard that AI CapEx is contributing 3 times its historical average to U.S. GDP, creating this virtuous flywheel of productivity, lower inflation, and higher growth.
So could this massive sustained AI build-out acting as this ultimate economic leverage, could this be the key that we need to start making a real structural dent in the national debt ratio? Something to think about as you watch the headlines and the CapEx data roll out in 2026.